Hello everyone and welcome to our tutorial number 4. We are talking about bank performance. Now bank performance is, we will cover few issues in bank performance, and actually it's related to part 1 and part 2 of the recording that I have uploaded for you. We also will have an extensive more problems, more discussions in the workshop. I will upload the workshop soon, and then we will meet also to discuss more issues in back performance this Thursday, 10:30 to 12. Now, if you allow me, I want to share my screen, and this is actually my tutorial. Because I'm going to write, I will actually hide the video now. I will turn it on later on. Okay. So this is what we are going to do today. Actually, this is tutorial 4, and we are talking about 3 issues. We are talking about, this is the T. This is tutorial 4. And we want to cover the following issues. One, we want to see something I didn't discuss it in the lecture, which is the difference between financial institutions and non-financial institutions balance sheet structure. They are different. And so when we do the comparison between the two, it doesn't work with us. We cannot compare a bank to a company. And I will tell you why. And this is actually incorporated in question number 1. Number 2, we want to talk about the financial institutions performance. And actually, this tutorial is concentrating on the Roi model and its implication. And we want to talk about what we call other key ratios. And actually in number 3, we want to talk about which is actually the most important thing, the integration of risk and return in the Roi model, or what we call it, the DuPont model. You can call it sometime the DuPont model. Okay, now having said that, if you allow me, look, the performance, the bank performance just to refresh your memory, is actually coming like this. We have what we call quantitative, and we have what we call qualitative performance. But this quantitative also is actually some of it internal and some of it external. When we talk about internal, we talk about the financial ratios coming from this financial reporting. You can talk about growth, you can talk about market share, you can talk about all financial ratios, profitability ratios, you can talk about what we call efficiency, interest rate differential, liquid, and the different type of risk measure like capital risk, liquidity risk, interest rate risk, and the rest of all those risks. This can actually come from the financial reporting, and it's quantitative, and it's actually internal. We can get this information from the financial reports. Then the external, which is actually the evaluation of others. And mainly we are talking about share price, or if we want to talk about it, market data. Now, in the qualitative one, as I told you, again, we have something called internal. And when we talk about internal qualitative, we are talking about plans. Does the bank have enough plans? Does the bank have good technologies? Does the bank have staff, good staff? So if you are talking about good plans and good technologies and good staff, this is actually most of the things that we are looking for. And actually, we want to talk about something called the CSR, which is how we are doing in the environment. Now, the external, which is qualitative, we are talking about the public perception, and we are talking about how we are doing with the regulations. This is actually, here we can also talk about products, financial products. The SSCSR, you can bring it here. So we have the public perception, we have the regulation, we have the corporate social responsibility. Here we have the plans, staff, and the products, which is what banking products we are following. In this tutorial today, we are talking about this area, financial ratios, and actually we are covering something called the ROE, and we are talking about the efficiency, some key ratios. Now, let me explain now something about this issue, which is the difference between financial and non-financial institutions' balance sheet. And I just want to take this small space to let you, if I have a bank like CIMB, this is the difference between the two types of identities. And you have another corporation like IGM, which is a big construction company. Now look for the items. This is the balance sheet items. We have here, say, total assets. Total assets in the bank is actually the loans, or 90% of them is the loans. You can have buildings or whatever. While here is actually the machines, inventory, and constructions. Bank, we have buildings, whatever, but it's just very small thing. But most of the assets we have in the loans. Now talk about the liabilities, total liabilities. 90% of those total liabilities actually is the deposits. And interbank, but maybe 90% for deposits plus other borrowings. Okay, while here is actually the liabilities is suppliers. Suppliers for machines, which we call it in accounting account payable. If you can look at now at this thing, if you are going to calculate the ROE, the ROA, for example, or the leverage multiplier, or anything that include liabilities or assets, you cannot compare. Because when you take the ROA for a bank, it's the loans, which we call it assets. In accounting, we call it assets. Actually, it's not assets, it's the depositors' money that are invested in loans. So this number, when we call about the ROA, which is actually the total assets, the net income over total assets, this total asset is very, very high in banks. So in banks is very high, while in corporate is very low. So actually, this will be very high in banks. High for banks. Now, the same thing involved anything called liabilities. So if anything you are calculating liabilities, for example, if you are calculating liabilities over capital, which is you want to calculate some measure of leverage. The liabilities over the capital will be very, very high also, because the liabilities here is the supplier, the liabilities here is the deposits. This will be also the leverage ratio will be very high in banks. So bottom line, we cannot compare between the two. The reason is actually banks perform something called, and this is the keyword, financial intermediation function. Having said that, let me go now to problem number 1. Look, this is a company, and this is a bank, and this is a bank. Now, when I come to compare the return on assets, if I am taking now what we call the ROI model. Just the ROI model, okay? And the ROI model is actually ROA, average multiplier, leverage multiplier, which is total assets over capital. And this is ROA, which is net income over total assets. And this can be break down to asset utilization, which is revenues over total assets, or profit margin, which is actually net income over revenues. If you are going to take this one and you want to calculate the return on assets, which is this one, we have total asset here. Anything includes total assets or liabilities, you cannot compare. And therefore, you can see the return asset for the company is 11.2, which is very high. You compare it for XYZ Bank or National Australian Bank, these people are getting 1.4. You will say, well, this company is doing so good, actually, in terms of the return on assets. Actually, you cannot compare because it includes total asset or total liabilities. Number 2, the leverage multiplier. Does the leverage multiplier have a total asset item or a total liability item? Yes, it has. And it is actually here. So my main my first impression, my first conclusion is we cannot compare. Let's see the number. This is the leverage multiplier, which means they finance their assets by 2 times their capital. So their capital actually, their liabilities is 2 times their capital, which means this company maybe have 60%, 66% of the assets from the lending or from the, and 33% from the capital. While for me, 14.3 times. If you take 14.3, if you divided this over 14.3%, you just, I didn't even calculate it, but if you, not percent, if you divided one, you will find this actually financing 7%. So 7% is the capital and the 93% is the liabilities, which is the money of the depositors. So again, I cannot compare this one and this one. Third one is return on equity. Return on equity is actually net income over equity. So is there total asset or total liability included? The answer is no. So actually, I can compare it. And then I can conclude, I can say with confidence that actually ABC company is doing 22.4, and this bank is making 20, this is giving the shareholder 20, 18. So actually this company is better for the shareholders if I'm going to invest. Now I can compare, but I cannot compare here and as I told you here. Having said that, just to answer this question, if it comes like a multiple choice question, and it has come so many times, the difference stems from the role of banks as intermediaries. What do you mean? The total assets are different. The total liabilities are different. Their assets actually are loans. Their liabilities are really deposits. So the raw materials for banks is actually the borrowed funds, which is the deposited money provided by deposits. Why is this happening? Of course, banks have high leverage and lower ROA than banks. So they have high leverage, which is right, and lower RA. High leverage, this is the leverage, 14.3 times, and lower ROA, which is 1.4, 1.3. So the stems from the, and this is coming from the financial intermediation function. Okay, I am now done with this part. Any questions in this area? Otherwise, I can proceed if you like, but I can wait for any questions. If you don't have, you can chat or you can talk. Any questions?
Sure, I'm good.
Thank you very much. So I will just move now to the next step in this tutorial, which is the financial institution performance. I will talk about the other key ratios. And actually, I will take you to this problem. Now, this is a real data, and I collected actually in 2015 from BankScope. BankScope was a database offered by the Monash. It has around 5,000 banks. This data base already discontinued. We used to give it to students to do what we call assignments and go on the data and collect Japanese bank, American banks, all, and just compare between them. I have the data. I still have the data, but until 2015. So when I take 2015, I take it for 2 banks in Malaysia. And I actually trying to calculate the following ratios, which is some key ratios. So as you can see, some of them efficiencies, some of them is interest differentials. Now, when I can, when this is when I take this one, and maybe this you will see it somewhere. So you will have the formulas and you will have the data. Just calculate very fast. Okay. So when I calculate here, the cost asset ratio, I calculate for public bank and find it 0.8. This is according to the data. I have operating expenses over total assets according to the formula. And I have the efficiency ratio, which is operating expense over operating income, one of the efficiency ratios. And I had net interest income and interest spread and interest margin. Now I calculated for my bank and for public bank and Maybank, which is 2 banks here. And actually, I wanted and make this one comparison between the two. I mean, calculation is not a big deal. I don't think there's, but I wanted to see. I started to compare. I find it to be the cost to asset ratio is high in public bank, but low in Maybank, which means public bank is spending more. We want this ratio actually to be less. I said, well, public bank is a very good private bank, very efficient bank. Why they are spending much? This is just my conclusion, and you can and when you comment in anything, you comment on it based on the information available. For the efficiency ratio, I find also Maybank is spending high here because efficiency ratio is actually operating expenses over operating income, which means how much each dollar of expenses will create for me, how much every dollar I get as an income, how much it cost me. It cost me 68 cents, while it is 57 in public bank. But then I find the net interest income to be here. This number you cannot compare because this is by size, which means if these people are making 52 billion and this is 53 billion, then it's just a size. Maybe by bank total asset is more and this is less. But at least it let you, this is in dollars. Now I went to the interest spread, which means how much they borrow and how much they lend. The spread is 2.7, while here is 2.43. And I found the interest margin, how much they take. These people take 2%, these people take 2.2. So when I told you last time, the financial ratios cannot give us enough information to conclude about, we have to dig. So if you are, for example, going and doing all those financial ratios, as I told you, it's a framework. You have to calculate the financial ratios. Then you have to calculate qualitative data, internal and external. And if you see the external, the quantitative and the qualitative external, including the market share and the growth is going in the same trend, all growing, that makes sense. Sometimes, for example, here, you cannot just tell about those ratios. Now, the only conclusion here, if you are trying to do smart guess, of course, in any exam or any what, I will accept what you say, but I will ask you for the calculation. But here, it looks like these people are spending more. Maybe they are training their staff. Maybe they are paying more salaries. Maybe they are investing a lot in the technologies. But actually, the customers are happy. Why? Because they are paying more. They are paying 2.7 here, and they are paying 2.2, which means either their expenses, the quality of the expenses of the providing those banking business is more. And of course, if you are bringing, you make a lot of training, develop systems, do whatever, you probably will spend more. And in the same time, if you provide good service to the customer is actually will be loyal to pay you more for the services you provide. This is because public bank is a very profitable bank, very successful bank. This is one of the things that I can conclude, and you can argue, but this is the data, this is real data, and this is what I collect. Maybe this is what I get, but any question here, any comments? So the take home from here is financial ratios as numbers are not enough to conclude results about bank performance. You need always more information. This is what we call the linkages, more information to make smart interpretation and responsible interpretation. Okay, can I move from this question? Any comments? Hopefully no comment. Okay, thank you. So the third thing we want to talk about the integration of risk and return, and this you have to understand it, which is coming to this question. Question number 2. Now, the question say the higher the PM, which is the profit margin, they are talking about this model. The higher is the profit margin, and the EU, which is the asset utilization, the higher is the ROA. Yes, if this is high, this is high, of course this is high. Now the question is, while high ratios produce high profits, because this will increase the ROE, financial manager need to be aware that high values may relate to underlying problems. Let's look whether there is any possible problems. I'm just trying to raise questions as we talked in the lecture, and then you need more information to conclude or to come to any results. I mean to confirm any results from your calculations. We say here it may involve, if this is the return, which is the rate, return on equity, this may include some risk, like credit risk coming from the loans, which is these two areas, or capital risk coming from the leverage. So this can create capital risk, and this can create credit risk. And operational risk. Now let's start with the EU. What would happen if, for example, as I told you, if this is ROE, and this is the leverage multiplier, this is the ROA, and this is the EU, and this is the PM. profit margin. What would happen if this number increases? This number is actually net income over revenues. And if you look to the income statement of the bank, the income statement of the bank is actually coming like interest income minus interest expense this is net interest income, and then you have to minus something called the admin and the tax to reach the net income. If I increase this number, I can't actually decrease the net interest income and net interest expenses. This is just well governed by the competition. What is the rate of deposits? What is the rate? I cannot play a lot in it. What is the rate of deposits? What is the rate of loans? And with the competition, I will be just close in some basis points, unless I am incredibly good in terms of my services. So actually, I can play only with this number. Because the tax, I cannot play with it. The rest, I cannot play. I can decrease this number. Admin expensive, I can increase it, so I can increase this one. Admin expensive is what? All these expenses, the operating expenses, including the spending for the system, the training, the compensations, the salaries, the bonuses, all of this which is related to the operations. Now, by doing this, I can, for example, as I told you, if one of you or I was hired as a CEO for one of those small banks, and then I decided to decrease the admin, I found people who are receiving huge amounts of salaries, and they deserve it, of course. It's not only in this country, in so many other countries. Bankers, which is the top management and this senior management, they receive sometimes salaries of 1 million ringgit. 300, 400,000 ringgits, a month. And the US, just millions and millions going to them. And because they, in VA, they make this innovation projects. They do so many things. They go in some dealings. So they are experts. If I decided as a new CEO and I say, well, I don't need these people. I just bring people who have been graduated from top universities like Monash, have experience like 5 years, bring them, give them around 150 to 200,000 salaries, and give them something like 50 to 100, bonuses a year. This is 300,000 a year. They will be so happy. They are young, they are active, they are innovative. They can work with me very well. Actually, if you are talking about very, very high top management and senior management, and you bring fresh graduates, they will work for you. They will do the work, but they will do the routine work. Now, later on, when you want to increase your market share of financial products or do smart trading in the market without experience, you can be exposed to much losses. Same thing, the system, which is your system of spending on technologies or whatever. If you say, well, I am happy with the current security system, I am happy with the current ATM machines and this payment system, whatever, that will take you for 1 year, 2 years. But after that, competition will take over and you will be obsolete. And this is actually what we call it, the failure or the backward of the systems, the technologies. If you are using backward technologies, or you are using less trained, experienced people in top management, you will be subject to operating risk. So you will decrease the expenses in the expense of incorporating operational risk, we call it. So this statement is right. Higher net income, maybe we are saying maybe you have to investigate. If it is suddenly comes and the net income is increasing, you have to check. It could be a result of a decrease in human capital or in the system, decrease in the number of high skills employees, for example. Okay, so this is operational risk. Now, last time I talked about the AU, which is this one. What if the AU has increased, which means AU, the revenues have increased. This revenue could be increased because I am charging, I am giving more loans, I'm giving more loans. I am substituting good loans with low yield, with risky loans, with high yield. So good loans I used to take 6%. Now I'm going to loans to companies that are very, very risky, leveraged companies, called leveraged loans, which means they are already in problems. They are willing to pay, and you can take 15%. Now this is risky loan will increase the revenues, which means it will increase this number. So the AU will increase, and then the ROA will increase, and the ROE will increase. So based on this, it could be, maybe this is the story, maybe it's not. So you have to investigate. If there is a jump in the revenues in this area, it could be because you are receiving, for sure, you are receiving more revenues, more interest income. The question is from where and why. So this is what we are talking about here. So the question here, total operating income, this is the revenues over the assets. Operating income, interest income plus non-interest income. If DI replaces low risk, low return loans with high risk, high return loans, he will experience an increase in the interest income ratio. Based on that, there will be higher default probability from this high risky loans, and we go to credit risk. So I am done with this question. Any question? Can I move to the next stage? Are you still alive?
Yes, sir.
Yeah, can I move on? Federico?
Yes,
yeah, okay, thank you. Thank you. Okay, now having said that, I think I finished most of the important questions in this tutorial. I have only these two questions. One question is about the financial ratios, which is number 3. Discuss the inadequacies of financial ratio analysis as a method of assessing bank performance. We said financial ratios is just these numbers coming from the annual reports. So we have the problem with the data, and this problem with the data is coming because we can always cook the data, or also accounting standards can help us manage accounting standards can help us manage the bottom line, which is the net income. So if you are taking this data, data from the financial reports, this is based on accounting standards that can be changed, and the numbers can be manipulated, and the ratios can be also manipulated. Problem with the ratio, it looks backward. So all those ratios is taken from financial reports that has been produced, which is actually the performance of last year and the year before, if you are taking many years back. And therefore, I cannot take them and expect the future, which means it will give me some indication about the future, but not the full picture of the future. Because when I take this information and I started to process it, I have an intention to invest in this bank or deposit my money in this bank. So I know the performance in the last in the last year. I just can assume that the financial behavior of the customers and the performance of the bank will continue in the future. But that is not enough. I have to have more information because sometimes in abnormal cases and more cases, either the bank is growing because it is penetrating more market and growing, or because or it is going down because it has some type of fraud or scandals or whatever that people starting to look at it bad. And in this case, the numbers you have seen last year may not be repeated. So this is another problem. The third problem is OPS is not included there. All those financial ratios, which we get it, either the ROE ratios from the DuPont or the other key ratios, they don't actually have off balance sheet. So actually, this is another problem. So the question is, it's a valuable tool, but cannot be used in isolation. Okay, so I am done with this one. What other indicators? We can use also the off-balance sheet indicators. We can use the qualitative, and the qualitative we have talked about internal and external. And when we talked about the internal, as I told you, we talked about the staff. We talked about the systems. We talked about the services. And we talk about the plans. This is internal. If everything here is going well and everything, evaluated to be good, well, improving, and the ROE improving, that is good. Now, you have also to look, as I told you, your relationship with the regulators and your compliance and the public confidence, this is the qualitative ones. You have also to look at the quantitative, which is the rating and the market data. And when I say market data, I mean the share price. These all have to go up if the ROE is going up. So if the financial ratios goes up, all qualitative should go up, whether they are internal, as I said, or external. And this is, we call it validation, which means they validate the financial ratios. Okay, so this is the whole thing. So yes, it's good, but it's not enough. So you have to have another information, and the other information is 1, 2, and 3. Okay, we have this question also, and this is about the ROA again. And the question is, say they want us to calculate. So they know that we know this relationship. So this is the return assets. This is the AU, and this is the PM, and this is the leverage multiplier. So they told us this is actually 21%. And this is the asset utilization is 11%, which is both of them is the ROA. And actually the equity multiplier is 12 times. Easily I can calculate the 3 factors, as I told you, this times this, which is actually the ROA, times this, and then I get the ROE. And this is what I did. So if I calculate this, if the question is what is the ROA? The ROA is 231. And what is the ROE? I just calculate 1 times this, which is, this is what I did. So this is actually 21% times 11% times 12 times, which is 27. So this is just using our understanding of the ROE. And this is a normal, multiple choice question, whatever. Okay, now number 6, discuss the difference between economic profit. To talk about economic profit, whether we are talking about the EVA or the RORAC, the concept is like this. If the net income minus unexpected losses, which means any losses that we didn't include in the normal course of the business, because if there is any provisions taking any expected one, it's already absorbed in the net income. When we charge the provision for bad debt under the normal situation to the provisions and decrease it from the cost of the business and decrease the net resulted in the net income. So now the net income is already ready, like expected losses we get. We have to decrease it from unexpected losses. And this is actually my cost to run the operation plus the unexpected losses. I have now to decrease this from the cost of capital. The normal thing, if the bank is just satisfying those ones, this should be 0, which means I have to pay dividends according to my cost of capital. So if the cost of capital is 20%, I am paying customers 20% on their equities, and I'm paying the depositors their money, whatever it is, 6%, 7% for their borrowing, and the rest, and there is nothing there. I mean, all dividends, and it can be a dividends, or I can pay them part of the dividends and part keep it, but still within the cost of capital. But if this is plus, if actually I can make plus here, then I have an economic profit. This is an economic profit. So the economic profit is actually a measure of the value added in any given period by a bank operation in excess of the cost of capital used in these operations. So this is how you look at it. In other words, if you take the income statement, and you have the interest income minus interest expense, assuming that's all, and then you have the net operating income minus the admin minus the tax, you get the net income. Remember, everything has been already absorbed for the cost of the business. Now this net income will go either retain earning if we are holding something, or will go for what we call dividends. But all of them, both of them should equal the net income. And the net income now, if it equals, for example, if the net income over the equity is 20%, and the cost of capital for my company for new shareholders is 20%, so there is no economic capital. There is no economic profit. But if the net income over the equity is 25%, which is now more than the 20%, that 5% is actually the what we call economic profit. Now, you don't have to go to this conclusion, to this calculation. All I want you to know is that the economic profit is actually is the net income minus unexpected losses minus the cost of capital. This is the economic profit. It can be anything. If it is minus, it's already losses. Okay. Any questions in this stage for this area? This is the last question. What does the BE, what does the price to equity ratio mean, and how do you comment if the bank price to equity is higher than the industry? Which means now, if your earning is 1, so earning per share, when you calculate it, is $1. Your net income can give $1. The industry, which is now, but your price of your share is 15, which means the earning is 1, price is 15. So actually your PE ratio is 15 to 1. You go to the industry, which is the same thing like you, and you find, for example, the average price of the shares, for example, is 30 for all those companies, whatever. Okay, or you take average, for example, of all of them is say 10. And the average, and they are paying the same. The average price of all those stocks of the competitors is 10, and you are getting, and they are paying earning per share 1. So actually it's 10 to 1. While you are working in the same industry and doing, why you have almost 150% of them, why you are operating in the same business, you are operating under the same environment, your profit, the other profits are okay. I mean, when you calculate the other ratios, you are very close to the industry. There is no big differences. It's just when you come to the BA ratio, you find very high jump. This is because investors know that your bank will grow. And therefore, your price here should be like the industry, right? It should be 10. But it already jumped to 15. That means they know they are willing to buy it. They are willing to bid for $15 for your, because they know that you are growing and you will make more performance and you will increase the earning per share. So you are growing and your future earning per share will be at least $1.5 per share. And this is why they are willing to pay you 15. Okay. So this is the whole thing, which means they are expecting that you are going to give them earning per share more in the future, which is actually to the industry, but you are going to grow. I am done. Any questions? You are so quiet today, my friends. What's the problem?
think it's all good, sir.
All good? Yeah.
Yeah, all good, sir.
So Ryan saying no questions, and no questions. Fine. So if there is no questions, I can. Yeah, it's almost 1 hour. I can stop the recording now. And I just want to say thank you very much for being cooperative in this. And now I can just stop the recording.